Good afternoon, everyone. I wanted to welcome you again to San Francisco. I know a lot of you are coming from different parts of the world, so welcome again. My name is Kathy Wong. I am a tax partner at BPM. My focus is on international taxation, and that's why I'm here today. I've been working a lot with international inbound companies coming to the US and setting up here. So I understand there are a lot of different challenges that they face and also things that they have to consider and pay attention to when they are setting up here, especially in the tax side. So hopefully, today I'm so glad that I have the opportunity to share some basic information with you and hoping that could be helpful for your business expansion into the US. Now, let's look at the agenda for today. There are quite a bit of things to cover, some basic information. I will touch upon a little bit on the US tax reform. That's a really big change and has a lot of impact to international companies as well. Second one is some common type of taxes in the US that you have to pay attention to while investing here. When new companies coming to the US, the first thing they need to find out is what kind of entity type they should use to set up in the US. So we'll go over that a little bit with the ownership structure. Once the company is operating and doing business in the US, then you need to worry about some tax credit and incentives to help reduce your taxes. So we'll go over that. Transfer pricing mostly apply to almost every single international companies that have intercompany transactions. So that's something that we will go over it as well. If you are selling consumer product or even sometimes providing services in the US, there will be state level of sales and use tax. So that's something also the business will need to think about and make sure they're in compliance with, because all the states, there are 50 states, but then all of them have different rules in terms of sales and use tax. Finally, we'll go over quickly on some tax return filing and disclosure requirements in the US for foreign companies. So this new tax reform was effective, it was an act in December of 2017, so a little over a year ago. And this is one of the biggest change in US tax system since 1986. So there are a lot of different changes in the US tax law, and a lot of the international companies are now making or changing decisions of how they're investing in the US because of the changes. One of the biggest changes in terms of the corporation income tax. It drops the highest bracket, highest tax rate of 35% for US companies to a flat rate of 21%. So US used to be one of the highest tax countries in the world, but now with the flat rate of 21%, a lot of the companies are now making different decisions about how they want to operate in the US or how to structure their operation in the US, because taking advantage of the lower tax rate is now one of the lower tax rate countries in the world. Also, accelerated expensing for certain business assets until 2026. This relates to purchases of fixed asset while using it for business, like if you have equipment, furniture, machinery that you need to purchase in the US. Usually, the depreciation, you can recover the cost over a period of time, like 5, 7, 15 years. But now there's an incentive for companies to invest in this type of fixed assets that you can get 100% deduction in the first year. So it's always good to have more deductions and accelerated deductions. So that's a good incentive for business planning to invest in fixed assets. Limitation on business interest expense deduction. There are changes. There has been an interest expense deduction limitation in the US, but then they just changed it now that it applies pretty much to every single company. And so when foreign companies are investing in the US, they usually need to make a decision about whether, how to finance the US operation, whether in terms of an equity or in terms of a debt. So with interest deduction limitation, now the way they finance the US operation may be a little bit different than before. So GILTI is one of the new tax regime under the new tax reform. GILTI stands for Global Intangible Low Tax Income. Before the tax reform, US company pretty much can defer their foreign profit in their foreign subsidiaries until they are repatriating the profit back to the US in the form of a dividend. But now, starting from 2018, there's no longer deferral of this profit. So all the these big high-tech companies like Apple, Google, that park profits outside of the US for a long period of time, that they accumulated profit outside of the US without paying US tax. Now they are required to pay tax in the US in the current profit of their foreign subsidiaries. There are certain deductions to it, but basically there's no more deferral until you repatriate back. So whatever you earn outside of the US now is taxable in the US. BEAT is base erosion anti-abuse tax. This is like an extra minimum tax for US company who are paying for services to their foreign affiliates. This a little bit relates to transfer pricing because if you are paying certain amount, there's a really complex calculation, but it only applies to company with 3-year average gross receipts of 500 million or more. So it applies to the bigger companies. Not all the clients are subject to that, but that's a new tax that is relating to payment to foreign subsidiary that they get a reduction in US tax base. These are all the, so the new, there's also a new incentive, tax incentive that's called FDII, Foreign Derived Intangible Income. That is a tax incentive for export income of US companies. So if you are exporting consumer products or providing services, or even making royalty payments or leasing payments to a foreign company, you're getting income from those, you're selling goods and services, or you are providing, you are leasing or getting royalty income from the foreign companies, then you get an extra deduction of 37.5% against your US taxable income. So that's a incentive to encourage US company to produce here and export to a foreign country. Very common types of taxes that you have to be thinking about while investing in the US. Income tax, there are 3 levels of income tax in the US at the federal level, state level, and on the local level. At the federal level, as we just mentioned, after the tax reform, now there's a flat tax rate of 21% for corporations. The state level, the tax rate varies by state. So each state has its own income tax rate, but in California, the tax rate for corporation is 8.84%. Local jurisdiction, they all also have their own tax rate, and some of the local jurisdiction has another layer of tax, but some don't. So it all depends where you operate your business. Sales and use tax, we have another session that specifically talked about that, but also sales and use tax is it varies by state and local jurisdictions. Payroll and employment tax, if you are planning to hire employees or you have employees here in the US, then you have to be worried about paying employment taxes, such as the Social Security tax, Medicare tax, the unemployment insurance tax. Those are all required when you are an employer here in the US. Withholding tax, there are different types of withholding tax. One of those are relating to employment as well. When you have an employee here, you are responsible for withholding their federal and state income taxes from their wages. So every paycheck you have a withholding on the taxes for your employees. Other type of withholding taxes are relating to if you have an interest payment or dividend payment to your parent company after making profit in the US, or there's a loan from your foreign parent to the US and you have to pay interest to back to the parent company, then there's also a withholding tax. The withholding tax rate is 30% on those interest and dividend payments making to the foreign owners or anyone that's foreign. And so the typical rate is 30%, but if there's a tax treaty with the foreign country, there could be a reduced rate of withholding. So it depends on the country. The company, the foreign companies first come to the US. The first thing they wanted to decide is which entity type should I use to set up my business in the US. And these are the common types of entity type that foreign companies operate in the US. Branch, C corporation, LLC, or partnership. And maybe we'll just take a quick look at the advantages and disadvantages of each of these type of entity setup. For a branch, it is the most simple way of setting up in the US. It's not a separate entity, but then there are a lot of liability issue to the foreign parent company, as well as the foreign parent company will also need to file a US income tax return, which is not always desirable for companies outside of the US trying to operate in here. And so C corporation is pretty much the most common type of structure while the foreign companies coming to the US and set up here. Probably I would say 95% of the company are using this type of structure. The advantage of this C corporation is that it can act as a blocker to separate the US activities from their foreign operations. And also the US company will be filing its own tax return instead of the foreign parent company filing a US tax return. So that's always something people wanted to do, just to separate it, and it also limit the liability and risk of the US operation to the US company only and not impacting anything in the foreign country, the parent company in the foreign country. However, the disadvantage of using a C corporation is that there will be double taxation. So the C corporation will be paying tax on the profit in the US when the profit is repatriated back to the foreign shareholder in the form of a dividend. The dividend is also subject to a withholding tax, and the tax rate normally is 30%, and it will be a reduced rate when there's tax treaty. But then the profit is basically taxed twice, so that's the disadvantage of using a C corporation structure. Limited liability company or partnership is a separate legal entity, but then it's not a tax-paying entity. So that one of the advantage of that is it doesn't have double taxation issue. All the profits are passed through to the owner, whoever the shareholder is. And if it's a foreign parent company, then the foreign parent company will have to file a US tax return too. So that's the disadvantage of using an LLC partnership structure. And also, if there are any profit in the LLC or partnership, they're also withholding tax either annually or quarterly to pay to the US government if one of the owner of the business is a foreign person or foreign company. So there are more administrative burden if using an LLC or partnership, but then it avoids the double taxation problem.
Say that again about the withholding tax. So if you are a foreign owner, either a company or a person, you will have a withholding tax to be paid on the revenues from that LLC in the US?
Yes, correct.
Oh, okay.
Yeah, yeah.
And what's the trigger? When do you start paying?
Whenever there is a profit in the partnership or LLC, then there is a requirement.
Okay, so that's every year when you have your tax declaration, they're going to review that, and if you have a profit the next year, you're going to have a withholding tax.
Yes.
Okay.
Yes.
Thank you.
Yes.
And also, is the withholding tax, is that a provision or is that monies that will not be recouped?
It's a withholding tax that the government takes first.
Yeah.
But then when the owner files a tax return to calculate the actual tax liability,
it's offset.
it's off. So
Yes.
if it's short, then you, the owner pays more. But if it pays the withhold too much, then there's a refund.
Okay.
So it's not it's a prepayment.
Yeah. That's true.
So financial U.S. operation, debt versus equity, as we just talked about the business interest deduction limitation, that will also impact the way foreign companies are financing the U.S. corporation, whether to do it as a debt or equity. If you use it as a debt, you may incur interest in the U.S. that is subject to withholding tax. And some of the interest may not be deductible because of the limitation. And if it's in terms of an equity, when the profit is paid back to the foreign company, there's a dividend payment, which is also subject to withholding tax. So there are goods and bads on each one of these. So it all depends on the particular situation. Yes.
So what about royalty payments? Are there limitations on the size of a royalty payment, like there is with an interest payment?
There's also a withholding tax on royalty payments.
Oh,
same 30% withholding, and depends on the country treaty, that will be a reduced rate, but there is a withholding tax on royalty. And if the company is over $500 million revenue, it may also be subject to the BEAT tax, BEAT, the base erosion tax. So that's something new from the tax reform. Some common mistakes that I see from people who are setting up U.S. operation. A lot of people are incorporating in Delaware. Delaware has a franchise tax, and even though their operation could be in California, but because of some legal reasons, Delaware is a good place to incorporate. And Delaware has a franchise tax that's not based on income, and it's based on your the share capital and also fixed assets. So it's nothing related to income. But if the share capital was not structured correctly, even you are operating at a loss position, you may get hit with like tens of thousands of franchise tax. So that's very unexpected for some of the business. So something to be aware of. Instead of paying taxes, you get some tax credits. This one I'm focusing more on the R&D tax credit, research and development credit, because it's the most common type of tax incentive that's available to taxpayers in the Silicon Valley and Bay Area for technology companies who are doing research and development activities. It's available to taxpayers with qualified research and development expenses. Some of the examples of the qualified research and development expenses are including wages that you pay to engineers that are doing R&D activities. And also if you contract someone to do a research, those are all qualified expenses for the credit. The tax credit is a dollar-to-dollar offset of income tax liability. And there are a whole calculation of how this is calculated, but just to get an idea is each dollar of the qualified research expense that you spend, you can generate about 8% of tax savings with the R&D credit. So for a lot of the startup companies, because in the beginning they are in a loss position, can they still benefit from this R&D tax credit if they don't have any income tax liability because they are not profitable? The answer was no in the past, but now the answer is yes. After a few years ago, they actually changed the law now that the R&D tax credit can be used to offset payroll tax liability even for a loss company. So even you are operating at a loss, you don't have income tax liability, is the R&D credit still valuable? Yes, because you can use that to offset your payroll tax liability. So if you have an employee, you have to pay Social Security tax and Medicare tax, so those can be used to reduce your liability using the R&D credit now. But you have to be a qualified small business, meaning your average gross receipt for the past 3 years is lower than 5 million. Then you can take advantage of that.
So is the R&D tax credit in this situation, that's a Californian tax, not a federal tax? So you can offset, because that would seem unusual, could you be able to offset a federal tax but with you'd be able to offset a payroll tax, which is a state tax, against federal tax?
So the R&D tax credit for the payroll tax offset is for federal purposes only. So California, you cannot use that to offset the California tax.
Californian.
Yeah.
That's right, California payroll tax.
But if you have a California tax liability and your research is done in California, then you can use, California also has a R&D credit.
Oh, okay.
But you can't use it for payroll.
But you cannot do it for
tax.
payroll tax, yes. The payroll tax is just for federal. So you can actually use up to 250,000 of R&D tax credit to offset your payroll tax liability each year. It pretty much applies, transfer pricing almost applies to all the international company with intercompany transactions. What it is because when there are two countries or two tax jurisdictions with different tax way, it is easy to manipulate where you want to park your profit. And that's why this transfer pricing rule is in place to make sure if you have intercompany payments, you have to be in an arm's length range. And so that includes intercompany selling of goods, providing services, and also royalty and licensing agreements. So anything that is intercompany, because they don't want you to be able to manipulate where you want to park your profit, mostly in the lower tax jurisdictions. And so in order to do that, we have to find a range that is a reasonable and fair price for the intercompany transaction, and that is in the form of a transfer pricing study and documentation. That would establish, so it's economic analysis and also benchmarking to see what would be a fair range of pricing for that particular intercompany transaction. So sales and use tax, there's no federal sales or value-added tax back in the US, only at the state level, state and city level. And each state and local jurisdiction would have their own sales tax rate and set their sales tax rules. And in California, it's about 9%. It applies to sale of tangible personal property. So if you are selling goods, selling consumer product, then you have to pay sales tax. And sales of services and intangible property like software may also be subject to sales tax, but it depends on each jurisdiction, because each state may have a different definition of what services or intangible property will be subject to sales tax. So it has to be when you are selling your goods or services to customers in multiple states, then we have to do what is called Nexus Study to see whether you are subject to sales and use tax in that particular state. To give an idea, this is a chart to show the state sales and use tax rate in the US as of January 1st, 2019, so it's a year ago. But the darker the color, the higher the sales and use tax rate. As you can see, the West Coast is more, the tax rate, sales tax rate is higher than the East Coast in general. So just to give an idea, every single state has a different sales tax rate. Finally, tax return filing and disclosure requirement. For company, they will be filing U.S. and state income tax return on an annual basis, so once a year. The due date for corporation is April 15 every year for calendar year and companies. And for pass-through entity, LLC, and partnership, it's March 15 is the due date, so it's coming. If the company is making profit, they also need to pay quarterly estimated taxes to the government, so the government gets the money sooner rather than when you pay it the following year. There are also different filing requirements for multinational companies with foreign owners or U.S. company with foreign subsidiaries. These are some of the examples of the forms that are very complicated, and Form 5472, 5471, and also if there's any bank account that the U.S. company has in a foreign country, it has also to report the foreign bank account information to the U.S. government. And it is very important to file this form because there are substantial penalties related to that. Usually it's 10,000 or more per form per year if you are filing these forms late, or it's non-filing. If you missed it, then it's $10,000 per form per year. So it's very important to understand the different tax structure and planning opportunities, as well as making sure that you're in compliance with the U.S. tax law to avoid this type of penalties, so you are maximizing your profit while reducing your U.S. taxes. So that concludes my presentation. So just some quick facts about BPM. BPM is one of the 50 largest public accounting and advisory firms in the country. We have over 40 partners and more than 500 employees now. We're mostly in the Bay Area. We also have offices in LA, Oregon, and Seattle. And we provide services related, we're a full service firm, so anything relating to tax, accounting, advisory, and consulting, we cover everything. Our industry knowledge, we work a lot with consumer business, technology company, real estate, and life sciences company as well.